Good afternoon, everybody. Thank you so much for joining us. We have a few disclosures we'll put up on the screen. So without further ado, I'd love to dive in and introduce our panelists who are going to take us through this conversation today. But one more quick heads up. If you've joined us for previous webinars, you'll notice that today's format is slightly novel. We're trying a new setup, a fireside chat. And while nothing is on fire quite yet, I'm not ruling anything out. So if things go a little bit sideways, please bear with us. But we're excited to be doing this in a new format today. So with that, I'd like to introduce my teammates here who are going to lead this discussion. We're joined by three senior members of our investment team. First, we have Andrew Wetzel, who's a principal and managing director of sustainable investing, and a portfolio manager here at the firm. Nate leads our work on AI, semiconductors, and the technology stack that is powering this seismic shift. And finally, many of you may recognize our esteemed colleague, Ellen Hazen, chief market strategist, who you might recognize from her monthly missives or her many appearances on television. Ellen brings a strategist lens covering macro markets and a little bit of history to shade what actually matters in terms of what's happening today in our client portfolios. So with all of that said, we should begin today's conversation the way many good conversations begin, with a definition, perhaps. Nate, can you talk to us about if there's any sort of agreement on what AI means?
Absolutely. So we can formally define artificial intelligence as systems built to perform tasks. At a more basic level, though, it's just software that finds patterns and makes predictions. We use it every day. So filtering the spam from your inbox, suggesting the next video on Netflix, even recognizing your face to unlock your phone are all just basic AI applications.
So we see that every day in our daily lives, but we've also seen in markets recently, certain sectors, and some more than others, really being pummeled. Why does it seem like everybody is so on edge about AI, both as an investment, but also as a disruptor in the workforce?
Since ChatGPT came out in late 2022, there's been a continual and steady progress in the evolution of AI. But recently, something shifted. AI systems are suddenly better at language, better at coding, better reasoning, and just simply much more capable all around. The tools are starting to search the web, execute tasks, and do things that humans typically do, even control household devices or robotics. OpenClaw, a popular open source agentic software, is now being used to perform entire workdays of tasks or perform scientific research and just do things that were previously unthinkable. And that's just 4 months old at this point. Anthropic's unreleased Mythos model, which you've probably heard about, you can find decades-old flaws in existing software systems. I've prepared 3 slides to kind of show why and how we've reached this tipping point. So the first slide shows the rate of improvement in a human equivalent task time performed by AI. So the way to think about this is if an AI can successfully do a task that requires about 20 minutes of human time, say searching the web, looking up a hotel, looking at reviews, making a booking. If it does that 50% of the time, then according to this benchmark, it achieves, about a 20-minute human equivalent time, before it's more likely to fail than not. If you go back to the fall of 2024 with ChatGPT 01, it was 51% of the time that you achieved a 19-minute task. By November 2025, it was about 3.5 hours, pretty remarkable progress. But in December, just December of last year, we were over 6 hours with GPT 5.2. And more recently in February, Claude could do a 14-hour human equivalent task time, almost 2 full workdays, and do everything correctly almost 80% of the time. It's just a stunning development. Going to the next slide, you can see this shows total estimated global token consumption. And it kind of plotted along at a relatively steady pace before going parabolic basically in October of last year. That coincided with the rise of intelligence and rise of capabilities. So my third slide, this is what's called the Artificial Analysis Intelligence Index. So it's a broad benchmark of 10 different benchmark tests run simultaneously or in line to determine an overall score of how a model does a wide array of different tasks and functions. The vertical scale shows the percent right, or the score the model achieved in the test, whereas a horizontal scale shows how many tokens were spent. So if we focus on the blue line, the dark blue line, which is ChatGPT 5.5, you can see if it uses roughly 4 million tokens for the whole tests, the suite of tests, it gets about a 45% score. You take that up to 16 million tokens and it's over 50%. You go to 60 million tokens, an incredible jump in token usage, it's 60%. And there's other tests and benchmarks that suggest as you go even further and use even more tokens for reasoning and thinking, the output gets better. So the point is that today's models are already incredibly capable, incredibly competent. We just need to add more tokens. So as you showed in the previous slide, the ramp and the sudden parabolic move in token availability has really created what looks like an explosion in intelligence.
Thanks, Nate. So if I'm understanding you correctly, it sounds like hardware is really the key to AI bandwidth. So with that being said, Ellen, how much do we need to invest in order for this trajectory to continue? And who will be footing the bill? It's not going to be me.
Great question. Thanks, Scott. When you step back, what's striking is the scale. Hyperscaler capital spending on AI infrastructure is now large enough to matter to GDP, to the economy, relative even to our deficit. It's not just a tech story anymore. It's an economic story. I think I've talked to many of you about this in the past, but this slide here shows what hyperscaler spending on artificial intelligence infrastructure is and how quickly it's grown over the last few years. And I did not update this after last night's earnings, but for both 2026 and 2027, you can increase each of those numbers by about $100 billion after last night. So the scale is just stunning. The top 4 hyperscalers companies, which are Amazon, Facebook, Microsoft, and Google, are going to spend over $700 billion this year just on artificial intelligence capital spending, and that's just those 4. So there are a lot of other players as well. There are other players besides those 4. We've all heard about OpenAI, Anthropic, and so forth. In addition to that, there's sovereign wealth, sovereign companies spending on AI and regular companies spending on AI too. So it's a pretty enormous impact. And you can also see the massive increase. This year, it's going to be up nearly 100% from last year. So another thing we're looking at, unrelated to the hyperscaler CapEx spending, is what's going to be the impact on the labor market. Now, a lot of people ask this, and we want to be careful when thinking about it because, as one pundit said, AI doesn't necessarily eliminate jobs, it just changes jobs, right? AI, as one pundit has said, if as an employee, you won't be replaced by AI, but you might very well be replaced by somebody else who knows how to leverage AI. I think a lot of changes are coming, and especially in the white collar or knowledge business that for many years has thought it was somewhat immune from this sort of job pressure in the labor market. So we do think that that is something that can happen, but we also believe that it's likely to be slow and gradual. It's not likely to be dramatic or overnight. I know some companies have talked about cutting costs due to AI, and we think that for the most part, most of those companies are merely papering over poor decisions that they made earlier, rather than this actually being a transformative labor technology for them yet. Of course, on the positive side, if you can replace some labor or if you can make your labor more productive, then you increase corporate productivity. And we've seen some estimates that operating margins could improve by as much as half a percentage point, which is a pretty meaningful increase in operating profits. So as we look at it overall, we think that operating margins are likely to expand. The job market will change, but it won't change dramatically, and it won't change overnight. And the numbers are pretty big, and they're starting to matter. So, Andrew, how we talked about how much they're spending and how fast that's growing, but how quickly can companies build this out from a physical standpoint? What are some of the physical constraints?
Yeah, it's a really important question. And so AI is technology. It sounds digital, but it is really physical. And so when you think about $700 billion in capital spending from just those four companies, that's going to build a tremendous amount of infrastructure. So how do we think about that? It's helpful to have a metric to kind of put some context around it. And increasingly what we're seeing in the industry is that the term gigawatt is being used to size the build out of all of this infrastructure.
So what exactly is a gigawatt? Can you put that in perspective?
Yes, so a gigawatt is a power capacity metric. It's not about power supply, but power capacity. And if you think about a gigawatt of capacity running at 100%, that's enough to power 750,000 typical US homes. So it's a tremendous amount of power. It's also worth thinking about what does it cost to develop a gigawatt of data center capacity. Research from Bernstein shows that it's currently between $30 and $40 billion to develop that 1 gigawatt across maybe one or multiple sites. If you just take the midpoint there and think about that $700 billion, that's 20 gigawatts of data center capacity. So it's a tremendous amount of infrastructure that's going to be built, over this year and in coming years. So it's really pretty incredible. As we think about the constraints to the question, there are many. One of the big ones that's top of mind for us and for others in the marketplace is skilled labor. So there's a lot of people involved in building all of this infrastructure. And we think about how important it is to electrify all this. Electricians are really important. We have 850,000 electricians in the US today. About 20,000 of those folks retire every year. So demographics are a headwind. So that's important to note. We also know that on average, it takes about 3,000 electricians to build a gigawatt of data center capacity. So that's 60,000 electricians that we're going to need to bring into this industry just to do this work. So just think about the scale of that relative to what we currently have. And you can tell that's a pretty significant constraint that's building.
How long?
I was just going to ask, how long is it going to take to build all that capacity?
It is going to take some time. I think, when we take a step back and think about these constraints, right? It's not just the skilled labor or the electricians. There are other constraints at play as well. And we think about networking as one. So networking is a big one. Thinking about trying to connect the chips to other chips, the racks of chips to other racks of chips. And increasingly what we're seeing is connecting data centers across different geographies and regions. So that's a big constraint to trying to build all that infrastructure. Memory. So we're talking about how quickly these models improve and the capabilities and how useful they are to businesses like ours and to many of you as consumers. You need context. And so that means you need memory. So memory is another big constraint. But perhaps the most significant is power. So, we talked about a gigawatt. A data center needs more than a gigawatt, which is interesting. So why don't they use different terminology? It's a good question. But essentially, the gigawatt of capacity for a data center is just the chips and the networking, the technical infrastructure. It doesn't include cooling of the data center, which is extremely important. It doesn't include other electrical infrastructure. You also have to think about doing these training runs or answering questions for anyone. They have to have significant uptime. So they have to run all the time. So you need a reserve margin and spare capacity. So a pretty conservative factor would be 1.25. So you take that 20 gigawatts of data center capacity, that turns into 25 gigawatts of power running at 100%. So it's going to be hard to put that together. If we think about our system, we have about 1,400 gigawatts of power in the US, just utility scale, not behind the meter, private power. But we built about 50 gigawatts last year. That's a tremendous amount of power. Half of that was solar. Solar doesn't run all the time. The sun doesn't shine all the time. And so the other half of that is a combination of gas and wind and other things. That's about 75 capacity factor. So 25 and 75. That 50 we built last year comes out to about 25. So if we built the same amount and allocated all of it to these four companies, that would be all of our incremental power capacity. Just think about that for a minute. It's really pretty incredible.
It is.
So it's kind of mind blowing. So to back to your question, though, Alan, how long is it going to take? It takes 3 to 5 years to build a combined cycle natural gas plant. There's a lot of work that goes into that. And increasingly, the turbines and other pieces of equipment are sold out for many years. And so that timeline is moving out to 7+ years to build infrastructure like that, power infrastructure. Solar and battery storage is available, readily available. There's equipment that can be built and turned on in 12 to 18 months. All of that depends on grid connection, which is another constraint. So it's pretty challenging to bring all of this on. It's going to take some time to do all of this work. If we think about rolling that forward to sustainability, we could think about decarbonization. So the companies that you mentioned, those 4 big hyperscalers, they're very serious about decarbonization. They have very robust environmental targets. They care about trying to transition toward a lower carbon energy system. And I think if we take a step back and just look at the environment that we're in, where there's a conflict or war with Iran, and we see spiking energy prices and lots of volatility in underlying traditional energy prices. And so they see that as a risk, right? As an operating risk as they bring all of this infrastructure on. So that's another rationale for moving toward less volatile renewable infrastructure. So these companies have signed massive power purchase agreements for things like solar, battery storage, wind, geothermal. And they're some of the largest investors in the next generation of this technology. So think about enhanced geothermal, small modular nuclear reactors. This is technology that will be game-changing over time. Right now, given what we've said here, it's pretty clear, I think, that there's a massive shortage of power and an incredible ramp in demand. And so every electron matters. And so there's going to be a lot of gas built in the next few years. And these companies will be the first to tell you that right now, we're going to see higher carbon intensity from all of this infrastructure build. But as some of that new geothermal and nuclear comes online post-2030, we should see a path back toward decarbonization over time in the economy. It's a 10+ year infrastructure cycle. It's very long term, and we're kind of just starting here.
Thanks, Andrew. It's really interesting, and it sounds like we'll be kind of learning as we go. But talking about the sort of seismic shift in technology and how it seems to be touching every corner of our economy, Ellen, can you identify any analogs for big technological changes like this in the past, and what's that meant for markets, but also participants in the economy like us?
So one of the things when people ask me, is AI in a bubble, that I look to is, well, how much is being spent as a percentage of GDP? And right now, with the numbers that we're looking at, it's about 2% of GDP, maybe a little bit more after last night's increase. And that's big. As I mentioned, that's big. It's meaningful. It's beginning to make a difference. But it's still not nearly as big as some of the other technological developments that we've had in the past. So for example, if you look at the railroads, when that was built out over 100 years ago, it peaked at about 5.5% of GDP each year. So that's a lot bigger than 2% of GDP. Similarly, if you look at the housing bubble, peak housing was about 3.5% of GDP. If you look at electricity, when that got built out, the grid back also about 100 years ago, that was about 3.5% at the peak. And even the internet bubble, which a lot of us remember more than some of these other ones, was about 4.5% of GDP. So it's not there yet. It's getting there. But what I will say is that the projections for 2030 are not 2%. The projections for 2030 are closer to 5.5%. So I think at that point, we get back toward peak areas. Now, as I think about this, though, it's not just the scale and the money as a percentage of GDP, it's how fast it's happening, right? So first of all, this build out is happening a lot faster than these other build outs were. Those took decades to build out. And this is happening in only a handful of years, maybe 1 decade, maybe even less than that. So the speed of the build out is very quick. But the other way I think about it, in addition to the speed of the build out, is, okay, but how quickly will it change society, right? And again, if you go back to these historical analogs, what you see is that historically they took decades to build out, but they also took decades to diffuse throughout the economy. And I think that's the real question here. These build outs are going to happen as fast as the natural gas turbines, et cetera, can be put in. But how fast will it change the economy? I think that in order to create corporate productivity, and implement AI in a way that's productive, companies are going to have to rethink their workflows. They're going to have to recast how they do business, what people's jobs look like. They're going to have to change a lot of things. And I don't think that will happen at the speed of AI. I think that will happen at the speed of people.
That's a good point.
So I do think that productivity will improve, as I mentioned earlier, maybe 0.5 point operating margin expansion. And we think there will be winners and losers as we look at this. Those companies that know how to implement AI and who do so thoughtfully and who are going to get ahead of this workflow recasting or reimagining, that will be one thing that will differentiate some companies for another. It's not just spending the money on AI, it's reimagining how you do work that's going to lead to the productivity improvements. So, Andrew, I know you look at a lot of company specifics. Are you seeing productivity show up in the numbers anywhere?
Yeah, it's a really good question. So, I think, just take a big step back and think about productivity. There's labor productivity, there's total factor productivity. These, economy-wide measures were really developed decades ago. Decades ago, we were a more industrial economy, so you could better measure inputs and outputs into the equation. We've transitioned to much more of an information and technology-focused economy. And so it becomes a little harder. If you think about many of the business models that we have today in technology, the consumer receives essentially a free service, right? It's free. It's backed by an advertising model or some other business model that is perceived to be free by consumers. It gets harder, and you add AI onto this, and it kind of flips in some ways technology and labor on their heads. So it becomes even more challenging to measure some of this. So, to your point, it's important to think about it at the company level, but it's going to be hard probably to forecast the productivity measures. What we have seen from academics, there's been some great academic work on this, no shortage of it, is that there's a whole range of potential outcomes that we could possibly see. At the low end, there are some academics who are looking for 0.2% annual productivity growth. On the high end, it's 2% plus. At 0.2%, we'd be basically standing still. At 2%, it would be transformative to our economy. So it's a very wide range of outcomes and impacts onto our economy. So it's hard to have high confidence that productivity is going to, be where it's going to be in that range. We tend to lean toward the higher end. We think it's likely to be a positive productivity driver. But to your point, again, it's important for us to look at it really at the company level as investors.
Are there some companies that you're looking at that have improved margins?
There are some that have improved. I think it's worth breaking it into a couple of different areas. So I think first, a framework. We like frameworks as investors. So if we think about very simplistically, productivity is you're doing more with the same or fewer inputs. So if we were to think about a company, it's revenue growth with the same or fewer employees, which should all else equal lead to higher productivity, higher profitability, expanding margins, right? So it's a really simple framework that we can use to understand how different companies are operating and changing over time. We've seen in the news, you've probably all seen some of the announcements from really big technology companies like Block or Meta, doing really significant layoffs, so cutting their labor forces significantly. We think these are red herrings. These are companies that have made, you could call it challenging capital allocation decisions over the last handful of years, either chasing acquisitions that were not core to their business, or really investing after growth opportunities that didn't pan out. We could think about the metaverse at Meta and having to unwind some of that. So it's really important to think about, beneath the surface here, behind the guise of AI, what's really happening at these businesses. And so we're always looking at those details. So with that said, there are a couple companies that we think are doing a really interesting job of integrating AI. So one would be Walmart. Walmart announced a strategic plan where they will do no net new hiring for 3 years. Yet they have pretty significant revenue expansion targets and margin expansion targets. So looking for better revenue growth and expanding profitability with no net new people. They're doing that through thoughtful technology and AI integration. Along with that, and to your point earlier, how do you bring people along? This is should be a human-centric transition, and they have a pretty robust reskilling and retraining program to try to help people with this transition and help them move into roles that are going to be more AI-centric and AI-focused. and improve efficiency across that organization. So that's really powerful. If they are successful with this, the profitability per employee is set to hockey stick higher. So we'll be watching that one closely, but that's their strategic plan. Another really good example, and this company reported earnings last night that the numbers were almost kind of hard to believe, is Google or Alphabet. This company is at the forefront of AI, right? They're one of the companies that really, right? They developed a lot of the early AI, and they're a leading AI lab through DeepMind, and so they're at the epicenter of all this, and so they are growing their business at an accelerating rate, which is really incredible. So last night they reported cloud revenue growth on a year-over-year basis of 63%. 63% year-over-year revenue. And then the quarter before, so the Q4 of 2025, they grew that 48%. Quarter before that, it was something like 35%. But you can tell there's this acceleration as you go through quarters in their revenue growth. Last quarter, they doubled their operating profit in that business. This quarter, they tripled it. Wow. So think about that. Yeah. This is a $400 billion a year run rate business that is accelerating revenue growth, big double-digit acceleration, and big profitability expansion. And it's very clear when you listen to this management team speak that it is through AI integration across their businesses. It's true in search, it's true in YouTube and elsewhere. This is what's driving that business. This is what's making outcomes from that business for their customers better. And so it is actively happening at both Walmart.
So, Ellen, rolling it back up to the economic level, what does this mean for consumers?
Well, I think that there is a question about capital versus labor, right? So as consumers, we are oftentimes workers. And I think that it's always a tug of war between consumers or workers and capital. So I think that is something that has played out through many technological innovations in the past. I don't know that this is necessarily going to be any different than that. But one of the things that we think about is the power shift between capital and labor. And we have seen capital grow power for the last, say, 40 years or so, roughly, with some fits and starts. But generally speaking, that's been, it's been labor that has lost a little bit at the margin. And that's probably going to continue or even possibly accelerate. Andrew, how do you think about it in terms of competition?
Yeah, I mean, to your point, right, you can kind of see some of this in the numbers, like whether it's, incomes, adjusted for inflation, or you think about corporate profitability margins, right? I mean, you can kind of see it in the data. It's really interesting. But your question, if you were to think about, operating environments and ecosystems in a less competitive ecosystem, so we could think about an oligopoly where there's just a couple, 2 or 3 competitors, and it's not as competitive. Perhaps that's going to be an environment where the companies will capture more of the productivity and profitability improvement through higher margins. You could think of online advertising, so think of Google as one of those, possibly one of those companies. On the flip side of that, think about a very competitive environment or ecosystem like retail. Retail is challenging, and so it's entirely possible that companies in that sector, over time, the benefits may accrue more to those customers or consumers as time goes on. So that could be a company like Walmart potentially long term.
So it sounds like it's just like any other technological advancement, that when you have cost structures that change, whether or not the cost, lower cost, for example, gets passed on to consumers or kept by the company, really depends on the market structure that the company operates in. So in that sense, even though this is a different technology, it's still the same basic economics and market dynamics that we've seen many times in the past.
Yeah, market structure hasn't changed.
Yeah, I think that's an interesting way to look at it.
Well, maybe we can change gears a little bit. And this is a question that I get asked a lot when I'm talking with clients. And Nate, I think you're best positioned to answer this. How are we as a firm using AI in our work internally?
So everybody's seen the headlines that AI is going to replace advisors, automate wealth management, commoditize advice. We see it completely differently. So we've been working with AI seriously for quite some time now, and we've learned that the opposite is true. When an AI is thoughtfully deployed, it can solidify and enhance the relationship between advisors and clients. And so around that principle, we built our program out with 2 core principles in mind. The first being that governance comes before adoption. We have an internal AI working group. We have a structured process for evaluating new tools and vetting our vendors as they introduce AI tools into our existing workflows. We have a policy framework to decide what gets approved, and it's kind of a multi-department framework. So there's a lot of coordination, company-wide to make those determinations. And we also decide what's prohibited and kind of what isn't an acceptable use case at this point. And of course, at the end of the day, everything is vetted against our fiduciary obligations. Second, we believe that AI should enhance and amplify the strength of our people. Like I always say, it should give us superpowers. We should become superheroes with AI. At F.L.Putnam, we think our greatest advantage is the strength of our team. The experience of our advisors, the credentials of our professionals, our investment analysts who would have an excellent portfolio management team, planners, service teams. It's a lot of people with very strong skill sets working together to serve the client. AI gives that team more leverage. So as analysts and portfolio managers, we process information more quickly. Our service team finds things they need, reconciles the statements or looks up information more quickly. Portfolio managers can surface information they wouldn't otherwise find. And just as importantly, it replaces some of the time we spent on repetitive tasks, allowing us to shift that time into where we create value, which is sitting across from clients, understanding their goals, explaining strategies, and building trust.
So Nate, I mean, all that sounds great on paper, but can you give us an example or two that helps to ground what we're doing?
So in the portfolio management group, which all three of us sit in, we're in the middle of earnings season right now. So we're getting, literally dozens of companies that we either own or have a strong interest in reporting earnings just back to back. Last night alone, we had earnings from Meta, Microsoft, Google, C.H. Robinson, Amazon, Chipotle, Ford, MGM. It was an epic night.
Yeah.
To help us better manage earnings season, especially on nights like those, we built some tools that help us pull together lots of earnings data, management commentary, press reactions, does some basic analysis like DuPont analysis, working capital analysis, and not just what an analyst might do, which is look at this quarter versus last. An AI tool can look at the last 3 years of trends, look at seasonality, and just do a lot more in-depth analysis, which ultimately doesn't give us less rigor. We're not automating our intelligence. It lets the portfolio managers and analysts get to the important questions more quickly. We spend less time gathering information and putting it together and more time thinking about what was new and what was said.
I think that's a very helpful framing of the way that we're trying to use some of these tools for the work that we're doing here as a team. As you said, the three of you are all portfolio managers at F.L.Putnam. How is AI changing the way you think about actual investment opportunities or how you construct portfolios? What kind of risks, opportunities, that kind of thing?
So maybe I'll start. To start, depending on the benchmark and how you define AI, large cap tech is 35%, I think 43% of the major benchmarks. So portfolio managers need to have a keen understanding of AI just to follow and track the companies that make up, growing toward half of our portfolios. So I think that's been a major step function. And I think, within our team, one of our greatest strengths is we have these capabilities and expertise to look at what's now, half the investment environment. I don't know if Ellen, you've got something from the kind of macro or top level picture, or the companies that you look at, how you're thinking about.
One of the things that we've seen over the last few years is that first it was all NVIDIA, right? Yeah. Because NVIDIA was in shortage. They were really the only company making the AI chips that were being used. And basically starting in 2023 and certainly in 2024, if you didn't own NVIDIA, that was kind of it. And then we saw it broaden out to a few other players also in the chip world. And then later it broadened out into other areas that were perceived as constraints, right? So whether it's networking companies, whether it's DRAM or memory companies, whether it is hardware companies, whether it is even the physical infrastructure companies, so the electricians and so forth. And Andrew, talk again about where you see the constraints on the actual build out of the data centers.
Just building on what I said earlier, and to your point, Nate, about all these companies, another one you didn't mention, I'm not going to say the name, but it's a major engineering and construction business, reported earnings last night. And, the stock has had an incredible move. It's one of the largest captive sources of skilled labor in our country. and they were able to significantly grow orders and backlog and profitability, much more than expected. That stock is
Much more.
14% today. And so these are the areas that we're spending a lot of time on. Like, where are these constraints? We've talked about some of them. These are the areas where we could spend more time on tokens and the cost of tokens and how, and then the cost and revenue that goes into the AI companies that are serving this capacity, and how that profit pool is likely to expand over time. And they see that coming. And so essentially they're willing to pay much higher prices for networking, memory, power, semiconductors, everything else. And there's others. But essentially that's where we spend our time, right? We're spending our time across the team on these areas that we know well, and carefully allocating capital to these areas that we think are likely to see better pricing power, higher levels of demand, and ultimately better earnings growth.
And I think the next thing after that, looking around the corner, right, is not just going to be the picks and shovels, not just going to be the companies that make the chips or the software or the LLMs or the networking equipment or even the engineering and construction companies. It's going to be back to what you said earlier, which is which companies are able to deploy it and use it. Companies that are not necessarily technology companies first and foremost. You mentioned Walmart, right? Companies that are able to improve their operating margins by leveraging artificial intelligence. So it's this rolling wave. First, it was about the constraints, and I think it still is, really, because there's not enough of everything to move forward yet. But as that gets built out, then it will turn into something else. Right. And it will help broaden the economy. It'll broaden more companies that are able to improve operating margins and grow faster, I think.
Yeah, agreed.
Like the opposite is also true. We've already seen software companies come under pressure in education space. Let's talk the consulting space could be at risk of AI tools. So I think we have to be able to be flexible and think about it in both directions. And again, the industry structure is a major component of that.
Absolutely.
Having worked here for 15 years and alongside many of you for 15 years, it sounds like the same investing philosophy still applies, just with new context and new inputs. So it's a really interesting discussion. With that said, we are going to pivot to questions and answers. We've had already a fairly robust Q&A thread going here, so I want to apologize in advance if we're not able to get to your question. Again, please leave your details in the survey and we'll be sure to get in touch with you to speak to your question. We'll try to get everything here today, and I'll do my best to direct these questions to the best suited person, but please feel free to jump in if you've got a good answer. I think to start, and this is maybe a good definition question, the topic of tokens has come up a few times. Nate, do you want to talk to us about what you mean when you say token?
Definitely.
And
That's a great question.
why does it create
Probably should have,
a bottleneck for AI?
Probably should have led with that. So it's roughly 4 characters. So rather than being a word, quite smartly, AI developers decided to break down words into chunks, averaging 4 characters. And by doing so, because those chunks can be chained together and put together words, they reduced the number of words, say in the Oxford Dictionary, from 170,000 to 50,000 tokens in the English language. It's also what gives language models the incredible capability of understanding typos, because it'll guess based on the probability if 2 or 3 chunks are correct. The first letter isn't. It's pretty adept at guessing what you actually meant to say, whereas if you were using a dictionary lookup, it'd be less so. So when we think about token output, like an NVIDIA H100, which is kind of the benchmark $30,000 GPU, it's kind of the bricks and mortar of AI today, it generates about 1 million tokens an hour. And a typical user of ChatGPT uses 330,000 tokens per month, just to give a little bit of a conceptual framework. Yeah.
So to be very clear, this is a separate concept from crypto or digital tokens.
Yes.
Yeah, that's helpful to keep in mind. Here's one that sort of echoes with, and Andrew, I'll direct this to you. Headlines that I think many of us have seen in our home states, but obviously with this big build out of infrastructure, data centers, fossil fuel needs, a lot of communities bristle at having some of these things being constructed in their neighborhood or in their community. So what's your thought on the natural tension between the growth that's happening and the money's being spent with people's discomfort with that kind of industrial build out, as well as people's discomfort with the idea of being taken over by machine overlords.
There's a lot to
Big
unpack
question.
there. Yeah, it's a big question. I think the discomfort is real and it's absolutely fair. To date, what we've seen is there's been a trend toward trying to site data center infrastructure closer to urban areas or sometimes in urban areas, and that is driving certainly frustration.
Because that's where the power was.
Exactly. And so it's kind of like, where can I turn this on as quickly as I possibly can? What we are starting to see is a shift away from population centers toward more remote areas with different types of infrastructure as they plan farther out. So that is certainly happening. But yeah, we're seeing local, municipal, state level pushback to AI build out. So part of that is due to the scale of the infrastructure that's being built. Is going from like a 50 megawatt to a 250 megawatt to a 500 megawatt to a 1 gigawatt scale data center. And that is just absolutely huge. The Hyperion data center from Meta, when you lay that over New York City, the island of Manhattan, it takes up something like 60%. I mean, it's really incredible to think about that. So these are increasingly moving to more remote areas. The fossil fuel infrastructure, right? They're having to connect these to all kinds of natural gas and other types of generators, diesel generators, even to get them going before they can get these grid connections. And nobody wants to live around that stuff. So we're starting to see some change there too, where there are companies that produce fuel cells that don't actually burn the gas or the fuel. It's an electrochemical reaction, so it's much cleaner. It's not noisy at all. And so we're seeing those companies benefit from a transition to something that's cleaner and also very reliable. So there's a lot of change happening underneath the surface, but there's certainly pushback, and we expect that to continue. And that's going to be another constraint.
I wanted to just add on to what Andrew was saying along that same line. When people ask me how quickly this is going to happen and how quickly it's going to build out, I often respond with, we still live in a democracy, right? And you see, as Scott alluded to, states, municipalities, local areas pushing back. And I think that we don't have to accept AI at the pace that Google or anybody else wants to grow it at. We have a voice, we're citizens. And I think that like any other type of big technological change, one of the ways that this should be governed is by talking to your representatives and making sure that people know how you feel. And I think that as a society, we'll get there. It may not seem that way at any given point in time, but I think that we will get there because I do think that a lot of people have this question and it's important to them. So as long as we still live in a democratic society, there will be ways for people's voices to be heard on this location and pacing.
I'm going to add one more thing. This question may be in the queue, so excuse me if it is, but I think there's an interesting higher level problem here in that, yes, these companies are competing against each other to develop this infrastructure, to serve this demand, to create these profit pools, right? So that's a natural thing in our economy and our system. But there's a geopolitical issue here as well.
Right.
And we haven't really talked a lot about China, but China's right there with us, right? In many ways, maybe a little bit behind, but they're right there. And so, our government in Washington sees that. And so there's a real interest in hitting the gas pedal in many ways in our country to make sure that we get to, when I say there first, I mean artificial general intelligence and artificial super intelligence. Nate, you may want to expand on that, but whoever gets there first will have an unfair advantage relative to the rest of the world. And so I think people in the know and in AI understand that concept. And so there's this really incredible tension between, big geopolitical planning and strategy relative to on the ground. I don't want to live with this stuff, right? So it's really interesting.
And sorry, did I interrupt?
No, you didn't.
That actually does segue nicely into a couple of questions we had specifically about China. And Ellen, Nate, Andrew, any of you can take this. But for one, how do our capabilities now, both infrastructure and technology, compete with what China has going on in the AI space, as well as the fact that China's 4 times our population and geopolitically a slightly different situation. So how can we compete with that in the years ahead based on some of the constraints that you've mentioned already?
I'll maybe jump in to start. China spends about 1/10 of what we do as a nation on AI infrastructure. And going back to the charts I showed at the beginning of the presentation, we've evolved from an era where the model matters. Like when DeepSeek came out, everybody was shocked because this new model was really efficient and good, and China had built it, to an era where the current models are incredibly capable, but you need a lot more tokens. So the US has a fairly significant advantage in the introduction of tokens today. Our 1 and 2 year data center plans are well ahead and more aggressive than theirs. But as power becomes a constraint, that kind of shifts an advantage toward China.
Right. China has the advantage in terms of power, right? They've just built out far more power and the capacity to build more power. The permitting and regulations are very different in China. They have the ability to develop all that infrastructure much more quickly relative to what we have here in the US. And so that again comes back to the natural tension here. And really, I think that's going to lead to data centers just increasingly pushing away from population centers. And that means we're going to need more networking to connect them to population centers. So these are some of the factors that we're thinking about that really do tie back to this geopolitical tension that is real.
Sure. A couple of questions on productivity, which I know is a Gordian knot to unwind, but some of our audience have pointed out that a lot of companies will enjoy a great enhancement in productivity, but not everyone will, and not all players will participate equally. And Ellen, you alluded earlier to the truism that AI might not replace your job, but someone who can wield it effectively might replace your job. So can you speak to the sort of intrinsic pressure between increases in productivity with some of these layoffs that you've mentioned, or the idea that there may be, some recessionary pressures associated with job loss?
I think that there was a paper that came out, I don't know, 3 months ago, published by a Wall Street research firm, or by a hedge fund, I think, actually, that talked about economic apocalypse because AI was going to kill all the jobs. And then because our economy is 2/3 driven by consumers and consumer spending, if consumers don't have jobs, they're not going to have any money. And therefore, they're not going to spend. And the whole thing goes into a tailspin. And I suppose that's possible. But what I would say is that if you study economics, you learn that economics is an integrated system where there are price changes and demand and supply changes in response to those price changes. And it's classic system dynamics, really. So when companies become more productive, what happens? Well, some of that goes to shareholders, some of that goes to employees. And so what happens to those people? Maybe the companies produce more goods and services that they can sell more, and that money gets recycled into the economy because they're spending more with their suppliers, right? So if you look at economics generally, it's sort of a closed loop system where there's still going to be economic activity and people are still going to be able to participate in that. So I don't think it's likely that we end up in a doom loop where consumers lose jobs, workers lose income, and the economy goes downhill. I think that, like all these other productivity enhancements that we saw with the railroads and electricity and everything else, people and with the internet, people's jobs got disrupted, and some people may very well be disrupted. But I don't think that it's going to be widespread. I don't think it's going to be like a hammer dropping all at once. It will diffuse over years, and there will be time for people to adapt. And just like with the internet, look at the business models that came out of it eventually back in 99, 2000, 2001, when it was first being built out. Nobody really imagined that Facebook or Google was going to exist in the same way. So I think that supply and demand response to prices always happens, and that will happen here too.
Let's take a bigger, longer term look at that question and think about demographics.
Yeah,
demographics
exactly.
are changing. Have been in a birth rate below 2 in the US for some time. Immigration is no longer a net inflow. That's material. So we have a situation where we're going to really need productivity. We're going to need AI, and we may need robotics. And maybe we have a separate webinar on humanoid robotics and that whole topic. Maybe not
in 2030.
Maybe not today.
Yeah.
But you can see China going after humanoid robotics and trying to automate much of their economy because they're at a much different point in that demographic trend than we are, in decline. And so, in big economies like that, we will increasingly need AI and productivity to continue to have growth and prosperity. So that is worth considering for a minute, a longer term look.
And AI capabilities enable startups, right? You can have greater business formation because all these tools are available. So if somebody has a great idea, they can start a company, start a business, and that leads to economic growth. So I don't think it's just so simple that people lose jobs and therefore the economy goes downhill.
Absolutely.
If I could go back just very briefly to a question of terminology, Nate, again, this might be best for you. The terms machine learning and generative AI often kind of tossed around. Is there a difference? Are they one and the same? And can you speak to that?
Yes. And so there is a difference and they're one and the same. So typically machine learning is tools and algorithms that find relationships between things. You know, a classical machine learning model is one that, say, diagnoses breast cancer from an X-ray. And very often it can pick up on just obscure things and patterns and charts that humans can't even perceive. But by recognizing patterns of being told, you know, which ones were positive and negative in the scan results, it can build this knowledge base that then predicts the future, or, you know, predicts the outcome in future X-rays. Language models effectively do the same thing, but with micro models. So you'll type in a sentence like, I want to drive my car to the, and just, you know, similar to how the machine learning algorithm gives an output for the X-ray, it tries to guess the next word. And it can use a lot of different context and conversation and history, but at the end of the day, it's just a prediction algorithm. You know, it's a little bit different. It's more matrix math, if you want to get into that, than a really advanced, you know, multivariable machine learning model, but it's the same core concepts, the same hardware, and a lot of the same workflows and even engineers that work on both systems.
Thanks, Nate. And can you talk a little bit more? You spoke earlier about the way that FLP is leveraging new tools. How do we make sure we're doing that in a way that still respects our priority of protecting client privacy and client data?
Very slowly and carefully. So I get to be in the hot seat in many times where you know, employees and customers and stakeholders, people want additional tools. They want AI to be rolled out and wider usage, you know, especially for more mundane things. But even in those instances, you have to be very methodical and careful. You know, you have to vet the vendor, the software. You have to be sure that your data is not going somewhere that you don't want it to be. You know, even when it's, you know, non-private data, and just our investment research, for example, we don't necessarily want to be sending that to Google and having them process our thoughts on, you know, a company or a business. So by building kind of an internal containerized systems, we have our own internal private secure system, you know, the same system that we rely on for, you know, Teams and Outlook and email communication with many of the same security protocols, containerizes and contains our early AI tools. So the combination of a very slow, deliberate rollout with, you know, especially utilizing Microsoft to build systems that kind of fit into our existing infrastructure that, you know, we know is secure and we're comfortable with, it has really led us to feel confident on what we've introduced.
And then I think probably our final question, keeping an eye on the clock here. If we look back to the .com bubble, there was kind of a crash and a lot of players got shaken out. Can you speak, can any of you, Ellen, maybe start, speak to the specter of some of this needing to pop and shake out? And are there players that are here today that maybe won't be tomorrow? Or what if a lot of this is hype and doesn't quite live up to the expectations we're talking about today?
So in terms of the AI spending not being productive or popping, it really doesn't have so much to do with AI so much as it has to do with basic finance. If you look at what happened when the internet bubble popped, and I was a tech analyst at the time, so I had a front row seat to that. And what happened is the Fed raised interest rates. There were a lot of companies that were not profitable, that were not generating positive cash flow, that had borrowed a lot of money. And they had their interest payments go up dramatically because the Fed raised rates. And yes, it was because of .com, but it wasn't because of .com. It was basic finance, right? When you're leveraged and you're not generating a lot of cash flow to fund that, and you rely on a perpetual motion machine of always issuing new debt or issuing new equity, then anything can happen to pop that bubble. And so I think the same thing would happen here. I won't pretend to know which business models of those that are out there today are technologically better or worse. But that's one of the things that we're watching. And some of you might see this in the client books. We have a chart that shows how those big four are funding their hyperscaler CapEx. So Microsoft, Google, and the other ones that I named, they're funding it out of cash flow. They're not actually taking on debt to do this. Now, that's beginning to change. But if and when we begin to see this pop, I think it will be due to classic basic finance where companies get over leveraged, interest rates go up, and they're unable to make payments. And then it's just a bankruptcy or other ways of failing, the same as every other story, right? Same thing happened with Dutch tulips and all the other ones, right? There are whole books written about the common themes that cause bubbles to pop. And they're common over time, even if the technology or the item is different each time. So Andrew, you look like you want to
Yeah,
say
I think
something.
what's great to see is that everyone's thinking about this question, right? This is you hear this is written in the Wall Street Journal and the New York Times and all kinds of publications, and it is top of mind, and so that creates the skepticism, which is very healthy. And what we're seeing in the marketplace, the market is reasonably efficient. Certainly not always efficient, but you do see the companies, to your point, Ellen, that do not have the same level of cash flow as perhaps some of the hyperscalers, have taken on debt, maybe fine. And if they turn the corner in terms of building the infrastructure and enabling that cash flow to pay down that debt, they'll see significant growth and they'll be great. But the market is discounting that here. And so those companies are trading at a much lower valuation, and their prices have not worked. Right. And so we're seeing that play out in real time in the market today. So it's not one of those mania phases like we saw in the late 90s into 2000, where everything is going up. And we can talk about some of those names that had no profitability like we have in the past. But we're not seeing that today. We're not seeing a mania phase.
And I would probably add quickly, even in last night's earnings, you've seen the market reaction to the companies that look like they're going to continue to finance investments out of cash flow is exactly the opposite of the ones that look like they're going to have negative cash flow in the second half of the year.
We saw of those four, one of them reported excellent growth that fully funds their CapEx and more. And then we saw the other end of the spectrum, a company that did not show that kind of improvement, and then today issued $25 billion in debt.
Right. So again,
that stock is down.
So the market is regulating.
Yes.
History doesn't repeat, but it does rhyme.
Absolutely.
Well, I think on that note, I can wrap things up, and I just want to say thank you to all three of you for your thoughtful comments, for answering all the questions that our audience shared today, and just to say, to try and encapsulate everything, seems very much like this is not just a trend or hype. This is, a powerful tool that is actively developing, and companies across all industries are learning how to integrate this into their workflows, including us. So it's really helpful for me and hopefully for our audience to hear about what we're doing, what some of the companies we're investing in are doing, and what risks and opportunities exist for our clients. So with that, I want to say thank you again to everyone in our audience for joining today. We will be producing a recording of this webinar, so if you stay tuned to your email, we'll send a link out for that if you want to listen again. And on behalf of the whole team, I want to say thanks again. We hope to see you soon. Thank you.